with market structure and how to simplify your Forex trading to streamline the processes of running this Forex trading business. A lot of emphasis now. I'm seeing a lot of emphasis on YouTube about trading psychology, about using the law of attraction in trading, about visualization and trading, which we're very excited to see other, I guess I'll call it influencers, put more of a focus on the internal knowing, the internal understanding of how to trade the markets. We could talk about support and resistance all day long. However, I mean, if you don't have the right wealth psychology to be able to move that conversation forward, then as far as your success goes in trading, it'll be more like a job instead of more like a transcendent career. So hopefully in this training, you understand something very valuable. You are very unique. You are very unique. The fact that you're watching this video makes you extremely unique. You're in a special group of people that are dedicated and committed to becoming better traders. They're dedicated and committed to understanding this market and its movements in a deeper way. It's not just what we're seeing, oh, only risk 2% or only do this, without any explanation of being how to be successful in doing that. So because you're watching this video, I need you to understand that you are very, very unique. And I'm very happy to have this time with you. I mean, you can just consider this to be a one-on-one session with me and you, because obviously I don't know where you're coming from as far as your trading background goes. However, my goal and purpose in my career of being an investor and educator is to relay complicated information in a simple way. And quite frankly, that's what we're going to do today with this market structure conversation. We're going to go over something really briefly. And like I said, if you do find yourself wanting more information, definitely reach out to me and my team, and we can get you set up for success with pointing you in the direction of which training will be the most beneficial to you where you are in your career. So let's start here. I don't know if you guys have recently seen that TradingView has been making a lot of awesome changes. They have a desktop version, which I'm super, super excited about, just because I do have parallels on my Mac. However, it's I just love the charting. When I say I have parallels on my Mac, I use that with my MT4 because of the wonky changes that they made. So parallels allows me to still use MT4 on my Mac. However, I went ahead and downloaded the TradingView desktop app to give it a go, and by far I do believe that the charting software on TradingView is phenomenal. So on your screen, I'm just going to clear all this off. Obviously we can re-add what we need to add. So wanted to talk to you guys about market structure. Okay, really brief conversation. It goes so deep. However, one of the books that I've read in my trading career that has helped me to really understand market structure is called Trading Chaos. It's by Bill Williams. And yes, that's the same exact Bill Williams that did the fractal indicator. When we go into indicators and you search for, let's go into indicators real quick. You can search for Bill Williams. Maybe if I put the name in there, right? So this same guy, Bill Williams, all right, chaos theory. He talks about how the market has an underlying structure. And this idea of chaos, I think it's very funny. One of the comments that he makes is that if you wanted to describe the complicated, I'm going to say it this way. He says, and I don't want to misquote him, so I'm going to explain it the way that I interpreted it. Sometimes in our world, we have a tendency to mislabel things. And quite frankly, we tend to label things as the exact opposite of what it really is, okay? So this idea of chaos, when folks hear the word chaos, they associate, or when some traders hear the word chaos and they associate it with the market, they maybe internally think of a market just being sporadic, not having any sort of pattern or any sort of ebb and flow. And so what Bill Williams talks about in Trading Chaos is that chaos, the word itself, is a higher form of organization. And we can embrace this idea that chaos is a higher form of organization. And so with that being the basis of this quick lecture today, what I need you to understand is that every single market, be it stocks, Forex, indices, whatever, futures, options, there is an underlying structure. And the better that you are at understanding the underlying structure, the more you will find ease in anticipating market movements. And so really quick, in this video, what I really wanted to focus our efforts on is waves. Now, he mentioned a comment in the book where you can put the Elliott wave traders, you can put several Elliott wave traders in a room and you won't get any agreement on the idea of which wave they're in. And let me just back up because I don't want to assume that you understand the wave theory or Elliott waves, right? So in the market, some traders that subscribe to the Elliott wave theory believe that the market ebbs and flows in a way. I'm just going to draw this on the screen and understand that this is just an idea. Sometimes it doesn't look exactly like this. Sometimes it looks exactly like this. However, what we're looking at is a basic, non-complex, very straightforward wave. And let me just say this before I go any further. The underlying structure of any market that you're looking at is a repeatable pattern. It repeats itself over and over and over and over again. That's one of the reasons why when I first started this channel, I highly encourage people to use the line chart. The line chart is very underrated. A lot of folks saying, hey, candlesticks this, candlesticks that. I love candlesticks. And sometimes when you're trading candlesticks alone, you might interpret something as something that it's not, right? So like, for instance, right here, someone may have thought, oh boy, this is quote unquote an engulfing candle and I'm going to sell it, right? And they might have sold here, not realizing that this is actually support, all right? And so these ideas, candlesticks, everything blends together. And the more you evolve in your understanding of the market, you will understand that the underlying structure is obvious. It's so obvious. It can't be hidden. Okay, it's like occult knowledge. And even that word occult, most folks think occult means hidden. It means out in the open. Nothing is secret. And so this idea of the wave theory, this version on your screen being a simple version of a wave. So counting the waves, you have wave 1, you have wave 2, you have wave 3, you have wave 4, you have wave 5, okay? And then what happens typically at a level of interest is you have some sort of reversal pattern, and then you go into correction patterns with A, B, C, D, E, F, G, okay? So let's just talk quickly about this side, okay? The wave theory on this side. So I'm gonna clear this off and get ready to take some notes. So this idea, we're just only gonna focus on waves 1 through 5, okay? Technically through 5. All right, so again, wave 1, 2, 3, 4, 5, okay? Now, what you'll notice is that in this brief lesson, I hope that you gather enough information to really just start backtesting this on your own. You don't have to take my word for it. This is not something that I created. This is not something that I made up. This is literally how the market ebbs and flows. One of the things that I always say is that the market is a living, breathing organism. And because you are involved in the market, because I'm involved in the market, it is a collection of people that are coming to the market with one objective, which is to earn money and extract money from the market, even if that quote unquote trader is an institution. So this wave theory helps us to simplify and understand where we are in a particular cycle. Now, I'm going to give you guys just a sneak peek of one of our trainings. In one of our trainings, I compare the movement to the market as a heartbeat, a human heartbeat. That conversation can get a little bit deeper. However, what you need to know about the wave theory is that typically when you have a market at a level of interest, you'll see some sort of reversal. And if this reversal occurs in a similar fashion to what's being displayed on the screen as far as 1, 2, 3, 4, 5, then you will understand better where you are in that market and how to participate. If you're anything like me, sometimes it feels like you'll come to a market, or back in the day, it'll feel like you came to a market, you're like, the market is always at support. The market is always at resistance. It's always moving. So it's, for newer traders, sometimes it's a little hard to understand where you are in the market. And by far, if you understand the wave theory, then that's going to put you at an advantage to making sure that you're trading on the right side. Now, 1, 3, and 5. Notice that 1, 3, and 5 are all in the same direction. I'm just going to put W1, W3 in this example. Understand if it works on the bullish way, it works on the bearish way. So waves 1, 3, and 5 are all in the same direction. That's not by accident, okay? So we consider these to be the trend, right? If wave 1, 3, and 5 are all up, then waves 2 and 4 could be considered corrective, or they could be considered pullback, right? Or opposite of the trend. And so in that instance, a couple of things that I would like for you guys to take away is that if you're struggling with understanding where you are in the market, study this pattern, okay? Study this simple pattern, and then go back and analyze how the market is responding. Now, you'll notice that the way that this is drawn on your screen, wave 2, okay, does not penetrate the integrity of wave 1. By that I mean, if you were in a market and you saw what you thought to be a quote unquote wave 2 return to a level as such, then this is no longer considered to be a reversal pattern or a wave 2. All right, so the key to that is understanding that wave 2 must not breach wave 1 to the point of return where there's like 100% retracement. Likewise with wave 4, okay? So wave 4 should not breach wave 3 to the point of no return. So if you see, let's say you thought you were in a wave 4 and you saw the market return to the level where wave 3 bounced from, then you say, okay, it's not a wave 4. I need to reassess. Now, one of the main concepts that I would go over and over and over again at the beginning of this channel was the fact that my career took off in trading when I just started to focus on wave 3, okay? The technical aspect of the wave 3, and you can find this information in the chaos theory, you can find this information in Elliott wave theory. Again, this is nothing that I'm taking credit for. This is just something that has been beneficial to me in my trading. So this idea of wave 3, if you do one thing well, especially in trading, you can make a fortune, all right? So wave 3, one of the reasons why I loved focusing on wave 3 when I finally found my stride in trading is because really I don't have to worry about predicting wave 1 or anticipating when the market is going to turn over. And now, granted, I'm very good at both. However, when I first started teaching, what I wanted to focus on is teaching people what was the most simplest way. And what I found to be the most simple way to get the most pips out of any market was by focusing on catching a wave 3. Now, why focus on catching a wave 3? In my research, in my experience, what I found is that wave 3 is typically 1 to 1.6, you can say 618, that's fine, 1 to 1.62 times the size of wave 1. Now, what does that mean? Okay, let me break it down for you in a different way. Let's say your wave 1 is 75 pips. Okay. Now, a lot of traders, for whatever reason, are like, oh, I just get 10 pips a day. I don't believe that philosophy. I believe that if you're going to trade the market, make it worth your while. So let's say your wave one was 75 pips. Okay. Let's just say it was 75 pips. Now, the wave theory teaches us that wave three is typically 1 to 1.62 times the size of wave one. So obviously we can do the math and saying that, okay, well, with that simple equation, it seems complicated, but I promise you, if you can grasp this concept, your trading will change forever. So one, we got that. So if wave one is 75 pips, we know that 1 times 1, or 1 times 75 in this instance, is 75. So what is 75 times 1.62? That would mean that wave three can ultimately deliver us results that would put a range of potential pip profit in this area. So 75 to 121 pips, or we'll just round it up and say 122. So what am I saying? Don't miss this. The idea of focusing on wave three, if you've properly mapped out a wave one and wave two, and you've seen what you needed to see to be able to participate in the trade, then that means if we're patient, wave three will basically give us what wave one gave us. And then not only that, because of the greed factor kicking in for traders coming into the market, the potential for that wave is up to 122 pips in this instance, in this example. So don't take my word for it. I'm going to break it down on the chart. So we're just going to go to a random chart. You guys know I love the USDZAR. We're not going to do that. We're going to just go to a random one so that you'll know that this is not something that I created or I'm just blowing smoke up your. So let's go. Let's do it. There was one thing I wanted to say before we did that. Understand everything aligns, okay? From the Fibonacci, even though Fibonacci isn't the original Fibonacci borrowed the knowledge from someone else. So what we have, or what we know as the Fibonacci retracement, is that not the 1.618, right? And so all of these things are designed. It's not on accident. Nothing is coincidental. And contrary to popular belief, the market is anything other than chaotic. It's very organized. It's very structured. So let's jump into a different chart so that we can put this information to the test. So let me clear that off. I'm thinking of a master plan. Okay, let's see. Let's switch it up. I'm rubbing my hands like Birdman. Let's go with a pair that I don't trade. Let's do GBPCHF. All right. Now, in a trending situation, sometimes it's a little bit, in a ranging situation, obviously waves are not the same, right? So we're looking for trending markets, obviously. So let's take a look at this area here. We can see a clear trend. We can see that the market was basing. And then we could see that for whatever reason, when the market got to this area, I don't know when these were put on here, but it must have been a long while ago. When the market got to this area, it took a turn. So let's see what I would consider to be the first pullback. I mean, obviously in this area, we haven't broke the high. So I would say, okay, I'm looking at this chart and I would say, okay, well, this to me is the first real pullback after it broke the highs. You may or may not agree. That's totally fine. So in what I can see, this is the first level where it pulled back. Okay, so this would be how I see this. I would say that this is my wave one, and this is my wave two. Okay, now notice what we said. The wave two, if this is a true wave two, then it should not breach, right? It should not breach the wave one. And even when we're looking at this structure, because there is structure in here, it may even be better to look at the market reversing from here. Okay, so I'm just going to adjust that just a second. So we'll do it from here. Okay, now we got our wave one. We said, hey, this is wave one, this is wave two. Now we said we can expect that wave three be at least 1 to 1.62 times the size of wave one. So obviously, based on this chart, it made a higher high. This would be, in my experience, what I would consider to be the third, the stop of the third, or the peak of the third wave. I mean, we could split hairs and figure out where to put the peak. However, let's just put it here. Okay, let's just put it here in the interest of time. Now, if that's wave three, obviously this pullback here would be considered to be wave four. Now, if we were to measure this, let's just take our measurement tool. All right. So we have and we'll just say, because this is, of course, measuring the percentage and all that. So we have 386. We'll just call it 390. So what that's telling us is that from the bottom of wave two to the top, or the peak, should be around 380 or 390. Now you see this, right? And I didn't even put it at the bottom. So this wave three was approximately 580 pips. Okay, so as it relates to this pair, we're not getting into the conversation of how to calculate a pip on this pair and what that would mean as far as monetary value. We're talking about the percentage in the price movement. So 580. Okay, we said it could either be 1 to 1.62. So we're just going to do the math. So let's say 380, right? We said 380. What is 380? I'm asking Siri because I don't want to embarrass myself on the internet. I don't have to. What is 380 times 1.62? That answer, you can do your math on your calculator as well. That answer is 615. Okay. And so I hope that you can see, even with this quick lesson, maybe this has been about 10 minutes, 15 minutes, there is value in understanding the underlying structure of any market that you're involved in. There is a simpler way to trade. You don't need a lot of complicated indicators. Even though Bill Williams has some great indicators, I've used fractals in my trading, things like that. Of course, the Fibonacci, or the psychological levels, those are very important. However, there is a simple way to trade with precision and clarity. And if you did nothing else, and this is obvious, I love this. This example is actually a perfect example. I love this clarity and the fact that this market told us that it was ready to continue with this trend change. And in that obvious engulfing candle, this is one of the patterns that most traders love. How beautiful was this engulfing candle? And if you would have gotten an entry on this candle here, you could have just taken that trade to the destination of either 380 pips all the way up to 615, which if we move it up to the height, it probably hit the 615. So again, I appreciate you for watching this video. This was just a quick breakdown of the wave theory and how we see the market in a simple way. It's not complicated. You can understand this, you can do it, you can start to apply this information. And I encourage you to go back and back test this information on the pair of your choice. And again, if you need more assistance, if you need more insight, if you need more information related to how to simplify your trading, reach out to us. We have two very different training programs. One, again, is designed, the FOREX Freedom Fast is designed to take you from A to Z. It also gives you more insight to building a trading business, okay? Next level. You're not getting that information from anywhere else. No one is teaching you how to turn your trading into a business. They're telling you about, oh, grab 10 pips a day. They're telling you about 2% risk, but they're not explaining, how do I make a business out of this? Okay, so that's one piece of the Forex Freedom Fast that is just worth its weight in gold. And then with the Pips Plus course, it is designed for a more experienced trader. And when I say experienced, maybe you've been trading for a year and maybe you're still finding your way in the market. And that program is completely self-paced. However, there are some excuse me, there are some personal consultations that you'll get along the way to ensure you're set up for success. So again, thank you for watching this quick video. Hopefully something that was said today will empower you